In this video, we're going to go over how to guarantee your retirement income outside of the stock market. For context, this is not a good strategy to try and beat the stock market or have big years, but rather just for those who prefer additional guarantees and peace of mind rather than a chance to return higher. My name is Daniel McCluskey. I'm the founder of McCluskey Financial, and the reason that I wanted to include that first point is because too often people who consider this strategy or people who are against a strategy like this forget this reason here, and that is that I was talking to a client not long ago who had run into an old financial advisor, great guy, and he had just mentioned to him, I just don't think that the strategy that you're using is going to return quite as well as if you had just kept that money in the market. And my client said, yeah, I actually agree, and I think you're right, but that's not why I use this strategy. I'm more so valuing the guarantees over the returns. So if that is the type of person that you are, or the type of situation that you might find yourself in, this video is for you. So before just throwing a lump sum of cash into a guaranteed strategy though, I like to start with this exercise of determining your income buckets. And the reason you're going to do this is to determine how much money you might actually want to guarantee. So I'm going to share my screen here, and you can see here this is an income box. Now you got to use your imagination a little bit here, but I'm going to draw a couple lines. First down here is going to be your need. So let's call this your survival income. That's how much money that if everything hit the fan and you needed to reduce your income down to the lowest possible amount just to make sure that you could survive and wouldn't have to get another job, wouldn't have to go back to work, ask family for money, anything like that, we want to determine what that is. Let's say in this example that that is $30,000 a year. And then we want to identify our current cost of living. So current COL. Let's say it is $75,000 per year, and then usually people will have some sort of dream income, and we'll just say that that is $100,000 per year. Now, the reason that we want to get clear on first what our current cost of living is and then our needs is because so many people, number one, don't actually know what their current is. They think it's one thing, but then you go back and try to budget it out and really count out your expenses, and you do got to factor in those one-off things. Because even if, it was someone's wedding this year and I wanted to get a lot of gifts for them, or I helped a kid pay for a wedding, or yeah, we had to take a trip this year for so-and-so's baptism, and that's not going to happen next year. We need to factor these things in because they're always going to be there, number one, but it's just important to know when we're planning for our income that we're not going to plan to take $50,000 because that's how much we think it actually takes us to live, but realize, well, in reality, when we're spending and we have these things pop up, we're actually spending $75,000 a year. So first, we need to create a budget, get very clear on what our current cost of living is. Then we can calculate just our survival or our needs. And the reason we're going to do that is not because if things hit the fan that we are going to try and reduce all the way down to those, even though technically at least we know that number, so we could if we absolutely had to in the worst case scenario. But really, because a lot of times people will find, and I exaggerated it maybe a little bit here, but this example, the gap between the current and the needs is so much more massive than they think. So really, a lot of the times you could end up retiring much earlier than you think you could otherwise just by getting clear on this picture. So here I have $45,000 as the gap. And what you'll notice if you kind of sit down and crank some numbers here is, all right, if things really did go downhill, I could always cut out $10,000, $15,000, $25,000 worth of expenses very easily. For example, maybe they're getting people very expensive gifts every single year for their birthday. They got a large family and they're buying $1,000 gifts or $500 gifts for people, and they realize, I really like giving. I like surprising my nieces and nephews and such, but if things did hit the fan, we could cut that out. And we could cut out a vacation, or maybe there's things that you're still paying for your children because you always had, but now they're getting older and you need to cut those out, and maybe they can go ahead and take on those expenses themselves. And they'll realize quickly that, well, in the blink of an eye, if things went downhill, I could very easily cut out, let's say $20,000, just to keep it as a round number here, and still keep a very similar lifestyle. The reason, again, we want to know this is not only to know that we can probably retire earlier than we think we might be able to, but second is because these are numbers we use to determine how much guaranteed income we might want. Now, in the title of the video, we call it the anti-stock market strategy. So if you wanted your entire income to be guaranteed using this strategy, you could. For most, probably not going to be the best case scenario, but for example, I know someone who they didn't have any children, they weren't worried about leaving money behind, they turned everything into guaranteed because now, in their eyes, they're quote-unquote making more money than they were when they're working just through guaranteed income. Of course, that's not actually the case. They had to pay to get the income via a pension. But if you're not in that situation where you want to leave money behind to people, or you're not really looking to guarantee your entire income, but only a portion, then that's the main situation where building out these buckets is going to come in handy. So let's say that it was $30,000 per year. Well, you can go ahead and subtract maybe your already guaranteed income that you have. If you have a pension, if you have Social Security, maybe your Social Security already covers this, the $30,000 a year. But if it doesn't, let's say that Social Security was giving you $15,000 a year. Well, maybe then you've decided, you know what, I just want to guarantee my needs and inflate that every year, keeping up with inflation, just to make sure that I'd be okay no matter what. I know I can live on this lifestyle if everything hits the fan. So if that was the case, then you can say, all right, how much money do I need to put in to guarantee an additional $15,000 per year? 15 plus 15 equals 30. Maybe you realize that you could cut out that $20,000 if you really needed to. Instead of spending the $70,000, now you're spending $55,000. So you say, I have $15,000 guaranteed by Social Security. Now I want to guarantee another $40,000, so I get to $55,000 total. So that's guaranteed, and the rest is coming from the stock market or wherever else, rental income, you name it. So if that was the case, then you could know here is $55,000 at this point. You already have $15,000 guaranteed through Social Security. So it's this amount here in between 15 and 55, which is $40,000, and that's how much you're going to guarantee. Now, the reason for guaranteeing your income or opting out of the stock market is pretty much exactly what's going on today. This is the S&P 500 currently. Market closes in about 14 minutes, April 16th, 2025. The S&P 500 is down 2.81% today. The NASDAQ is down 3.8%. Stocks are selling amid a tech sell-off and a warning from Fed Chair who just wrapped up. He might actually still be talking about a tough decision that they await with interest rates. We kind of don't know what's going to happen with tariffs, and because of that, markets are down today. But what I have to point out, even though 2 weeks ago the markets lost 11% in the last 2 days, a little more than that, technically, we rebounded a week ago today as of the date of filming, a week after Liberation Day, as Trump calls it. And the market was up 9%. However, it's crept back down a little bit since then. And as you can see, it's still doing that today. But I want to point out, even though it's almost down 11% year to date, this is not meant to be used as a scare tactic for people. Most people know in the long run, the market is always almost going to outperform an annuity, a buy your own pension plan of any sort. Look at the last 1 year, not just year to date, but the market's still up 3.83%. So even though all of this looks scary here at the end, we're still up in the past year. Over the last 5 years, 87%. So even though there is going to be drop-offs when you are getting closer to retirement, sometimes people just aren't going to be able or aren't willing to go through that and deal with a lot of the stress that comes with that. I can say, for one, I'm in a public speaking club, and the second day that it was down 11% combined, couple weeks ago, I went in the morning, this Friday morning after markets had just opened, and people were just tense post-Liberation Day, just seeing what was happening with the stock market, watching their 401ks go down from every $1 million they had, they lost over 110,000. It's stressful for people. It obviously worked out to where it came back the next Wednesday. Now it's trickled down a little bit since then, but just around every straight corner that I'm currently turning, you hear someone mention 401k, and you hear someone worried about what the market's doing. That is what you're opting out of. It's not that you're going to beat those people because they bought and held this entire time through all the ups and downs, and you didn't, and you moved it over to a guaranteed place. You've got guarantees, they don't. They're probably going to perform better long term, but you have the peace of mind and the guarantees there in exchange for the returns that they are likely to get. Of course, we don't know. You could, of course, beat them. If 2000 to 2010 happened again, well, then you would be in great shape taking your guarantees over what the market is doing. All in all, though, we're not doing it to try and outperform them. We're just doing it for the guarantees. I just can't emphasize that enough. As I said here, warning of some challenging scenarios here for the Fed on tariffs from Powell. This is live currently. He was just speaking, or he still is speaking, and that is that I want to pull up here. These are the interest rates currently in the past 10 years. We're about as high as we've been. Payouts on fixed index annuities are as high as they've ever been in the last 10, 15 years. And since that's the case, and that they are experiencing a difficult decision here with Fed rates coming up, Trump's pushing for them to go down. Whether they go up or down soon, we don't know. Of course, everything with the tariffs going on makes things uncertain, so he's not sure if he wants to rush into cutting them. But rates are expected to be cut at least 2 more times in 2026, or not at least, but 2 specific times in 2025, rather, apologize there. And then in 2026, continued to be cut, most likely. We don't know that for sure, but if that happens, then the payout rates for fixed index annuities are going to drop. Just like you've probably seen advertisements for CDs or high yield savings with your bank, those rates go up and down with interest rates. Same deal for the payout rates for insurance companies. Next thing here is just that the peace of mind that people are buying with this sort of strategy is so much more valuable to people than it used to be, just seeing all what's happened with COVID, seeing what's going on with tariffs right now, and that's very evident just by the fact that I have here fixed index annuity sales are up over 100% or just under 100% for the past 3 years. This is 2021, 63.7 billion in sales. This is 2024, 125.5 billion. LIMRA projects strong annuity sales through 2027. I can see here projecting, it released in January, 432 billion across all annuity sales. So booming in popularity. Why? Because people realize that what they do at retirement sometimes is going to look different than what they did for retirement. So let's look at a couple different options to guarantee income. These would be one-to-one rollovers if the money is being provided from a 401k or an IRA, and you're turning on income when you would like. There's different products, different companies. So you need to make sure whatever one you pick from the very beginning best suits your very specific scenario. But these that we're going to look at are all set up specifically for maximizing retirement income and not any sort of returns. First one we're going to check out here. This is a 66 and 65-year-old joint couple taking income immediately. The premium amount for them was $311,000. That's just rolling one-to-one over from another account. And if they did that and turned on income immediately, they would be getting $21.36 thousand per year guaranteed for the rest of their life. Now they're also taking this jointly, which essentially means when the first one passes away, the second one is going to continue to receive that income into perpetuity. So even if you pass away, your spouse would still receive the income. That's an example for 66 and 65-year-old. Here's another one of a 56-year-old female taking income immediately with $275,000. This is with post-tax dollars. That's why they're able to take it before 59.5, if anyone was wondering. They would get $17.49 $1,000 guaranteed for the rest of their life because they're not taking it jointly. The percentage that they're going to be able to take based on their age relative to what the 66-year-old is able to take 10 years later is actually going to be higher just because they are taking it single and not joint. But since she's younger, then she would also get a lower percentage than if she waited until she was older. So if that was confusing, essentially the younger you are, the lower payout rate you're going to get, as opposed to if you wait longer, you'll get a higher one. And if you take it joint, you are going to get a lower payout rating than if you just took it single. One more example here. This is a 60-year-old male who deferred income out 1 year. So he technically did this when he was 59, deferred it out 1 year, and then at the beginning of policy year 2, the premium was $1 million. He'd be able to receive $72.67 thousand a year for the rest of his life guaranteed. If he waited 2 years, the beginning of policy year 3, it would continue to increase and so on. So the main thing to point out with this one, and I didn't pull up an example of a longer deferral period, but you can see he could wait 5 years, and there's an arrow there on the right because he could continue to scroll down. And what's important to note about that is a lot of people will wait to get into a strategy like this until right at retirement, like they're 1 year before, 2 years before, 5 years before, and they move into a vehicle, they defer it out, and they start taking the income. A lot of the times they're just taking it immediately. However, you can also defer these out and get guarantees that come along with that. So if you're 55 years old, you move over $500,000 with a 10-year deferral period, you'll be able to get, with certain companies and products, guarantees for how that money's going to grow over the 10 years, and then the income you'll be able to take. As an example, if it was $500,000 and they deferred it out 10 years, let's say they took it single, usually you're going to get a comparable amount to if you did an immediate income for $1 million. So over 10 years, you can expect the income to be similar to $1 million immediate, at least with the current interest rates. If those drop, well, then of course it would be lower. They're guaranteed though at the time that you buy it. So that's all that really matters is when you buy it, what are the guarantees? If interest rates drop after that, well, good for you. You got ahead before that. Lastly, a couple things I want to point out with this is that you do want to look at this holistically with the rest of your strategy. If you are doing all of your money into this strategy, a couple problems are: one, if all of the money is tax deferred, you are opting out of stock market volatility, but you're not opting out of tax rate volatility. So if taxes rise, then that would be something that would affect you. If you don't have any sort of gold or silver or anything to hedge against if the US dollar became less and less valuable, that's another potential risk that a lot of people don't think about. And also, if you don't have ones that adjust for inflation on top of Social Security, which does adjust for inflation with the cost of living adjustment, then that would be a concern as well 15 years into the future. If you're still taking the same income you were 15 or 20 years ago, well, it's not going to get you quite as far. Hopefully this video was helpful. If it was, I do ask that you subscribe. I release videos going into greater detail 3 days a week. I also do a live stream as well. Please do leave any questions or comments down below. I'll make sure to respond to those, and subscribe, and I'll see you in a future video.